Hey everybody, how you doing? Hope you guys are all enjoying your day. Today I'm going to be talking about two different things. I'm going to be talking about something that Robert Kiyosaki in the book Rich Dad Poor Dad spoke about a lot, and that was paying yourself first. As well as I'm going to touch on something, particularly in this section right here, that a lot of people have trouble understanding, and that's how taking a loan from your IUL actually works. All right, so let's just jump right into the video. All right, guys. So again, pay yourself first. What did Robert Kiyosaki really mean when he said that? Well, what he meant by that is, first, let me talk about what not to do. So this is what 99% of Americans do. They get paid from their job, their regular 9-to-5 job, and they go ahead and put their money in the bank. I actually just made like a TikTok video, and I forgot that I crossed it out because you're supposed to cut out the bank. So kind of ignore that for now, the X through it. But anyways, most Americans put their money straight into the bank. And then what the banks do is they go put that money straight into BOLI, which is nothing more than just an IUL, just specifically designed for banks, bank-owned life insurance. There's also COLI as well for corporations, and then there's an IUL for individuals, but they're all the same thing. And they make trillions, millions, billions of dollars off of your money. So when Robert Kiyosaki talks about paying yourself first, he's saying before you go pay your bills, before you go and spend money on getting a car and buying a house and paying off for vacations and jewelry and designer bags and watches and Gucci sunglasses and stuff like that, you need to pay yourself first by putting your money into assets, not into fungible designer things that are going to depreciate in value and that your money is just going to get spent on commodities. So paying yourself first is putting your money into assets. Paying somebody else first is buying commodities, right? You're paying the bank, right? You're paying the bank first because the bank is moving your money around and making money off of your money. So when you put your money in the bank, you're paying the bank first. When you get your paycheck and put your money in the bank, you're paying the bank, and then you take your money out of the bank to go buy a Louis Vuitton purse or a really expensive watch. You're paying Rolex, you're paying Louis Vuitton, you're not paying yourself first. So he talks about paying yourself first all the time. As soon as you get money, put it into an asset that you own, right? And well, that asset that we're going to be talking about today is an IUL. So an IUL is an Index Universal Life Insurance Policy. Now, before you run away and click out of this video because I said the two words life insurance, just bear with me for 2 seconds. So, you are getting this IUL because you want to leverage the cash value accumulation account inside the policy. And that cash value accumulation account, because it's under the umbrella of insurance, is on a completely different set of rules than any other account in the financial industry. And the reason for that is because insurance is such a different type of structured vehicle that it can do many, many different things that no other vehicle can possibly do because it's not life insurance. So again, let's just say you opened up an IUL through me, right? You clicked the link in my bio, you booked a consultation with me, and we ended up opening up an IUL for you, right? You have $20,000 in your IUL, because what we really mainly talk about is all the people who have $20,000 sitting in their savings account or checking account, $5,000, $10,000, $20,000 plus you have sitting in the bank. That money is actually losing its spending power and cash value because of inflation. The money in here is getting less than 1% interest. Inflation's around 5% interest. It's actually even more now. But again, you want to put your money somewhere where you can beat inflation. Again, that's going to be an IUL. So any lump sum of money that you have just sitting in reserves in the bank, and let's just say you put that into your IUL. So now you have $20,000 in your IUL. Let's get started, all right? And you've been accruing 10 to 12% interest on your money for a couple months. You've had the policy open for, like, let's just say a year for easy math, right? And now it's time and you want to go ahead and borrow the money out. How does borrowing actually work? A lot of people think they know how it works, but they really, truthfully have no clue on how it works, because I'm about to blow your mind, all right? So, you're gonna borrow this at 2%. You're borrowing the money at 2%, right? So what does that mean? Well, you don't actually borrow the money. This is actually what happens. So, you have borrowed the money out of your IUL. So since you borrow at 2%, borrow, quote unquote, take a loan from your money, this is where a lot of people get kind of like, they don't like IULs because they assume that when you borrow or take a loan from your IUL at 2% interest, so you're taking a loan at 2% interest from your IUL, that you're getting charged interest to have access to your own money or to borrow your own money. That's not actually what happens. This is where people get confused. So let's just say you went ahead and took $20,000 out of your IUL, you borrowed it as a loan. You borrowed it as a loan. Why? Because loans aren't taxable. You can't tax a loan, right? So since you borrowed it at 2%, this $20,000 is still sitting in your IUL. It's still there. It never left. Even though you borrowed the $20,000 out of your IUL, the $20,000 is still sitting in your IUL. The only difference now is that you're accruing 10% interest instead of 12% interest because you took a loan of $20,000 of the insurance carrier's money. You borrowed $20,000 from your IUL when really what happened is that you took a loan from the insurance carrier for the equivalent amount that you had in your IUL, and they charged you a 2% interest rate on that loan from using the insurance carrier's money. This is how uninterrupted compound interest works, right? So even though you're going to use this $20,000 in, let's say, real estate or a startup business or any other assets that you want to throw your money into, you can do that. But guess what? You have zero risk. You have no risk attached to these assets because it's not your money. You're not putting your money into this. You're putting the insurance carrier's money into these assets. So therefore, you have no risk tied to that. Now you might be asking yourself, yes, I do. I have to pay that loan back. You don't. You don't actually have to pay that loan back. You know why? Because at the end of the day, again, just like we spoke about over here, it's life insurance. And if you have a cash value accumulation account under the umbrella of life insurance, guess what? You have a death benefit because it's life insurance. Again, we're talking about the different set of rules that life insurance is structured upon. So you have a death benefit. Your death benefit, let's just say for the example of this video, is $500,000 death benefit. You took a loan from your IUL. You took a loan from your IUL at 2% interest. Well, you don't have to pay that interest back. You know why? Because that interest right here just gets subtracted from whatever you were accruing. So for the sake of this video, for the example, you were accruing 12% interest on your IUL. You borrowed at 2%. So again, 12 minus 2 is 10. So now you're getting a net of 10% interest on your money in your IUL, and you got that loan for $20,000. So again, how is it possible for you not to have to pay that back? Well, because when eventually you pass away and your beneficiaries would have gotten paid this $500,000, but because you took a loan out and never paid it back, which is literally the purpose of getting an IUL, is take loans out. There's no credit pulls, there's no credit checks at all. Your credit score could be 0 and you can still take these loans out. So you took out a $20,000 loan. So $20,000 minus $500,000 is $480. So your beneficiaries are just going to get paid out $480 instead of $500,000. So that's the entire purpose and premise of getting an IUL, is being able to borrow money, take loans out, and never pay them back. That's why millionaires and billionaires leverage these accounts so aggressively and leverage these type of cash value accumulation life insurance policies so aggressively. That's why banks use them. That's why corporations use them. COLI, corporate owned life insurance. BOLI, bank owned life insurance. Why do 99% of corporations own IULs? Why do all of the banks use IULs? It's because they have a pool of money in the IUL. They take it out at a super low interest rate, 2%, guys. And by the way, you can only get 2% with me or with my agency. Everybody else is going to be 5%, maybe 8%. For me, it's 2%. Remember that. It's 2% for me. There might be other agents out there that could possibly offer it for 2%, but to my knowledge, I'm the only agent out there that I know that is marketing that they can offer 2% interest on that. That is extremely low, guys. So again, I hope that you guys understood this full process. If you don't, go ahead and comment down below any questions, or better yet, just click the link in my description, book a phone call with me, book a consultation with me. It's 100% free. You can just ask me questions over the phone, and then I can also go ahead and just send you more information after the phone call. And if you decide, you know what, an IUL really is what I need, what I want to leverage an IUL, then on that phone call, we can go ahead and get an application sent into you, into the life insurance carrier, just because we need to send in an application just so that they can look at your medical history and then decide whether or not they want to accept you, because you have to qualify for this. Not everybody can do this. Only people who qualify can do this. So go ahead and book a call with me, book a consultation with me, and myself or a person on my sales team will go ahead and reach out to you directly. We'll go ahead and call you. And then you can ask us any questions you want. If you're still kind of iffy about it after the phone call, we'll go ahead. I can send you some articles, some other YouTube videos, just to really further explain and the process too, just so you can have a true understanding of how these insurance policies are structured. And also, again, if during our phone call you decide, you know what, this is definitely something I want to pursue, then absolutely we'll go ahead and get that application submitted right there on that phone call. And then again, we'll just wait for the underwriter's decision. Once you get approved, boom, I'll start structuring the policy for you. So if you guys gained any insight, or if you guys liked the information you heard here, go ahead, make sure to like this video. Go ahead and share it with any friends and family that you think could benefit from this information. And guys, make sure to subscribe to my channel. When you guys like and share and subscribe to my channel, it really helps my channel out. I am giving you guys all this information for free. The only cost is just to give it a thumbs up and just to subscribe, because it really just has YouTube go ahead and push my content out to more people, just so I can educate more people in this process, because it's kind of crazy how many Americans have no idea about cash value accumulation, life insurance, and how this can really boost your financials. So I just want to try to educate as many people as I possibly can, and I definitely need your help in that process. So please, please, please share, like, and subscribe, and enjoy the rest of your day.